Welcome to Ask an Advisor, where we here at Team Clark go deeper on all things investing, saving your money.
Inflation, the American dream.
Yes. So today, on today's episode, Wes, you're going to talk about a couple of things. The American dream, what does it take? That's been in the news a lot lately.
What does it cost?
It's
a pretty high number.
And then, is inflation good?
Supposedly, according to Investopedia study.
Oh, okay. And then, is inflation good or bad for the stock market? You asked me this morning, and of course, I promptly got it wrong.
Well, you got it almost right. You were close.
We'll see. I don't know. So
it's more complex than that. So maybe let's just start with that. And this was prompted by really a reporter question asking me to sit for an interview talking about inflation. Mm-hmm. And it's a really simple question if you think about this. Is inflation good or bad for the stock market? And I thought, wow, that's such a simple question. Do we really want to do an interview about it? And then as I thought about it for a second, I thought, well, wait a minute. It is pretty nuanced. There's not just a super easy answer, but I'll start with the super easy answer, is that we want Goldilocks inflation. If you can imagine that we're in a nice, not too hot, not too cold zone, 0 to 2%, closer to 2%, that's the zone the stock market seems to like the most, at least historically, if you go back over the last 50 years, and that's where we see the best performance. If we get to a point where we have lower inflation than that, the reason that inflation and usually interest rates would be super low is that the economy is starting to have a little bit of a problem. So even though it's not necessarily a bad environment for another couple of reasons, that's a different rate of return than we found when inflation is sub 2%. Then it's pretty clear if we go from the 2 to 4% zone, returns come down. We go to the 4% plus zone as far as inflation, then returns come down even further. So we'll go through this number. So first of all, there is no one variable that impacts how the market does. In fact, it's even more nuanced than that. It is really the question goes to what kind of stocks do well when inflation's high, what kind of stocks do well when inflation is low. So there's really two layers of that. So I'll start by just saying there are all sorts of variables that are determining whether stocks do well or not. Valuations, earnings really is what drives equity prices higher over time if earnings are growing. So there's valuation, there's how the economy's doing, there's interest rates. So there are so many layers of variables in order to figure out this question. But if we were to isolate and just say, well, let's just look at different inflation regimes, different inflation environments over the past 50 years, and see how stocks do, just in general, the S&P 500, before we break it into different categories. And here are the numbers. If you look at when inflation is greater than 4%, so that's getting pretty high. It's high, yeah. And obviously we've seen, if you go back to 2021, 2022, we saw 8-9% inflation. In that zone, rates of return on average are in the 6% range, which again, not great relative to stock market history. So it's pretty clear that really high inflation just isn't great for stocks. So that's the first answer. If you go to a moderately high zone, 2% to 4% inflation over time, stocks average a little less than, just a little bit less than the overall market return at about 10%. But the sweet spot, or the Goldilocks zone, inflation not too hot and not too low or too cool, that's when you get 14.2% average rates of return. So that's better than
high,
market
yeah.
history.
Mm-hmm.
So that's the zone that the stock market really likes. Some inflation, not too much inflation, but we also don't want less than zero, which we've also had some periods of time where we've seen a little bit of deflation. Now, there's not a ton of data for that. So even though average rates of return for the stock market, when we have inflation less than zero over the past 50 years, there's not a ton of data on that because it's a pretty rare event. But you see a 13% average rate of return. I wouldn't put too much stock in that data because it's just a really small sample set. It's really just, there's only a couple of months even where we saw inflation less than zero. So that's the larger answer to the question, which is we want to see for the broad market, if you're an investor, you want a little bit of inflation, not too much, not too hot, not too cold. That's the Goldilocks inflation zone. if we dig a little bit deeper, and we've done a lot of research on this over the last several years, and if you go back to 1960, Krista, and we're looking at a lot of history here, that corollary really holds true of how I just talked about this. And if you go to the 1960 to 72 period of time in America, we had a Goldilocks inflation environment. It was inflation averaged 2.9%. I mean, that's kind of relatively in check and low. And stocks did pretty well, about 9% a year. Dividend stocks did about 12. Growth stocks did about 9. So there's not a huge disparity between the two. But then you get into these extreme periods, and I would call the 1973 to 1982 period. That's an extreme.
Right.
Hyperinflation. Inflation averaged 9% a year. 9 for that long stretch of time. That was a very different environment. Dividend stocks did pretty well. They averaged about 11% a year. And growth stocks, as an example, think of today, what would be a dividend stock? Think of a utility company, a bank, an industrial company that pays dividends. They're growing, but not extremely fast. Growth company, think of the big technology companies that don't really pay dividends, but they're trying to grow at 20, 25% a year. That's a growth company. That growth companies did really poorly during that period of time, just barely above the flat line, averaging only 2% a year. So it also stands to reason that you can think of really high inflationary environments, good or better for, still not great for anybody, but better for dividend paying companies. Really low inflationary environments, very good for growth oriented companies. If we have low inflation, we probably have low interest rates. So investors are more willing to say, well, I can't get much sitting my money in cash.
Savings, yeah.
I'm going to go ahead and invest in a company that may have good returns, but way out into the future. So that's when the market pendulum swings toward growth stocks, when we have really low inflation and low interest rates. The takeaway for investors, we're in the Goldilocks zone right now. We're not quite at the 2% level, but we're under 3% for inflation. And that's still a pretty decent environment in general for stock market.
Okay. All right. Are you ready for questions?
Let's do it.
If you have a question, you can go to clark.com/ask. And Jassen in Georgia did that and wrote this question.
Okay.
I'm currently halfway through my career, but I'm looking to branch out to something else entirely. I've looked into getting my CFP accreditation, but it says you need a 4-year degree before the exam or within 5 years of taking the exam. There are also hours that need to be gathered for experience. As someone who would be doing this part-time around their full-time job, how would you advise me to move forward? While my current job isn't my passion, I've developed a true passion for helping people take control of their finances rather than letting money control their lives, and I want to share that with anyone willing to listen. Your segment has been a great addition to the show, and if Clark has to cut back, I'm glad they filled the gap with a financial advisor like you. That's nice. Thanks, Jassen.
Jassen, what a cool question. And here's the deal. Did Jassen tell us his age?
No, but halfway through his career.
Halfway through his career. I'm going to assume he's 40, 35, 40?
Probably.
This is cool because, and there's a problem in the financial advice industry, and it's almost counterintuitive because you think of how technology has made everything easier to invest, and there's more things we can invest in at a lower cost, and there's so much advice swirling around. You would almost think there's less of a need for financial advisors, but I think it's because the world is even more confusing than it's ever been. It's the opposite, I think, is true, which is there's even more of a need for financial advisors. And demographically, our industry, financial advice, is a really aging industry. 50% of all CFPs are over the age of 50.
Oh, wow.
50%. 40% of today's advisors are supposed to retire by the year 2034.
Wow.
Again, that's kind of right. In the next, 9 years, you're going to see almost half of the industry retire when we need that many more people. That many more people need help. So we have a supply and demand problem. There's so much supply of people needing advice, and the the supply of advisors is actually contracting pretty rapidly.
And then the supply of non-advisors giving advice on TikTok and stuff is expanding, which is
Probably
scary.
expanding. I don't have TikTok, so I haven't seen that, but you're probably right about that.
Oh yeah.
So you would be part of the solution, Jassen. And we need folks like you that want to do this. But part of the reason we're in this imbalance is that it is really a long road to get the CFP. It's 6,000 hours of experience in the field. It's 4,000 hours of structured apprenticeship. It's a 4-year degree. It's an exam, which I'm glad I took that exam right out of college because I was still used to studying and I was working in the industry. I had graduated from college, so I was still in test-taking mode. I've seen people that go back in their, let's call it 30s and 40s, and then it's like, well, I got to restart and figure out all these different sections of the CFP, and then I have to sit for a 6-hour exam.
Oof.
So it does take a lot of time. And then if you don't have your bachelor's, you've got to get that within, I think, 5 years as well, what he's saying. So I would just say this, the most logical way to get this done is that I think you've got to get a job, a part-time job, an apprenticeship somewhere in the financial industry. So let's say you're an engineer and you're working full-time. I know it sounds really tough to do, but you almost have to get a job somewhere in financial services. And once you're in that job, and it doesn't have to be the perfect financial job, but it needs to be something that gets you in kind of the jet stream of being in the industry. I think it's also it's much easier to pass the CFP test if you're already in practice as well. I think if you do it purely and academically, it makes it really, really hard. So I know it's a hard road. We need you. But I would also say that the most realistic way to really get this done is have an internship, apprenticeship, part-time work, even if it's 10 hours a week. That will put you on the road to being able to accomplish that long list. And it sounds like it's a passion for you, so I know you can do it.
Awesome. David in Texas says, Mr. Moss, is there any benefit in having a low-cost, high-yield bond ETF as part of my portfolio? I see it as an extra yield boost to the current total bond fund I already have.
David in Texas, you're a multi-asset class income investor. So I love the thought of having a lot of diversification, how you're getting your income. So that also means a variety of stocks and stock categories that pay income. But the bond side is what you're asking about and talking about. And high yield bonds, they have done really, really well, I would say, over the last several years. So I'm not against them. They are for more aggressive investors, knowing that they have a lot of volatility. They're not like watching the total bond market index, which moves only a little bit. High yield bonds, they may not move as much as equities, but it's pretty close. And when you're getting a 6%, 6.5% yield, which is about where high yield bonds are paying today, it comes with some risk and some volatility. So I would use it as a satellite or a piece of the overall, not the whole portfolio, number one. Number two, they don't count as dry powder. So if you're looking at the safety portion of your portfolio, and we're looking for highly safe, let's call it high quality corporate and government type bonds, high yield bonds, remember that they've been renamed just to make them sound less bad, which is they used to be called junk bonds. That's what high yield bonds are today. They just have a nicer title to them.
A lot nicer.
High yield. Oh, that sounds good. Junk bonds.
Wow.
Very different, but they're the same thing. They've just been rebranded.
Well, that's quite a rebranding.
It's like how the estate tax was rebranded as the death tax.
Yes.
Words matter. So the industry figured out how to make them sound less bad. But over time, if you're in a diversified, let's say an ETF or a fund that has lots of different high yield bonds, then you've probably done pretty well over time. So where are yields today? High yield bonds are in the 6.5% range. Government bonds are going to be more like the 4% range. The 10-year treasury today is a little over 4%. And the reason I say that is that you're not getting a ton of extra yield right now. If the industry would tell you that high yield spreads are very low, and that just means that you're not getting a whole lot of extra risk to own a low-rated quality company that has bad credit, essentially. We have to be careful. And when the economy goes awry, then high-yield bonds can take big hits, 5, 10, 15, even 20%, depending on what kind of crisis we go into in America. If you go back to the pandemic, high-yield bonds fell almost as much as stocks did.
Wow. Yeah.
But you do get this 6, 7% yield along the way. So I think they're a nice complement to an otherwise high quality dry powder section of the overall portfolio.
All right, Chris in Washington says, hello, Wes. Thank you for adding another podcast to your busy schedule and helping Clark wind down with other endeavors he enjoys. I have a simple question that has confused me since I started listening to financial podcasts. I understand the amount needed for retirement is based on what you plan to do in retirement. However, I like to use the generic benchmarking system out there, such as Fidelity's, to make sure my wife and I are not falling behind in retirement savings. My wife and I are 7 years apart, though. She just turned 30 and I'm 37. Fidelity states you should have 1 times your annual income by 30 and 3 times by 40. I started late saving for retirement when I was 30. I currently have $250K and do not think I will hit the $360K savings goal by 40. My wife is at $60K but would need $100 to be on track. We are both in new jobs now, which do provide pensions if we stay where we are for at least 5 years. We also have a brokerage with about $50K invested. My question is, should I be looking at our individual incomes and individual savings to match ages when comparing to the suggested, or should I be incorporating out full home incomes and retirement amounts, assuming my age is our age? Thank you.
Whoa.
It's a lot.
That's a lot, Chris.
And by the way, I don't think 30 is late. If you look at statistics, you're early, man.
It's not at all. And he already has 250,000 saved.
I mean,
another 50, really 300.
Yeah.
Here's what I would say about this: the age multiplied by your income and where you should be charts. I think they're fascinating. Like if there's a new article that pops up and I haven't seen that chart for 3 months or 6 months, I always look at it.
You love a chart.
I love a chart. I love a table.
Mm-hmm.
So I don't blame you for looking at these things. They are at least somewhat helpful. Mm-hmm. Totally get it. But I would scrap that chart completely. Just throw that chart out. And it's nothing against who publishes it because most financial firms publish the same chart. It's just math. But it's confusing. It's particularly if you've got a big age gap between you and your spouse. It's your age. It's your income. It is the age of your spouse, your age. So that could be different. Depending on what your income is, maybe your income is artificially low right now, maybe it's artificially high right now. Does that really matter? What matters is what you need to spend in retirement. Mm-hmm. So this is a generic benchmarking system to make people feel guilty. So I would just scrap it. Don't even look at that. Remember, financial planning is about making the complicated simple. And that chart kind of makes it even more complicated. Here's how you make it simple. Just use the 25X rule. And think less about what you're earning today and what you're going to need to spend in retirement. And if you do some quick math here, and I'm going to just use the financial calculator. If you've got $250,000 and you average 6% a year, and let's say you are 37, so 25 years, you'd be 62. At a 6% rate of return, if you're saving $15K a year, mm-hmm. and this is compounding on top of the 250 you already have. Well, you really have 300, but let's just do 250. For the next 25 years, just mathematically, that comes out to $1.9 million. Mm-hmm. And if you're using the 25X rule, think of it this way. If you need 50K times 25, that equals $1.25 million. Right? Mm-hmm. So if that means that you could, if you've got Social Security and you may have a pension, and I would think putting all that together is 50. If you have $1.25 million, again, 50K times 25 is 1.25. That's the 25X rule. You would have another $50,000 on top of that. So then you have $100,000 per year in retirement that can escalate higher for inflation. That's how I would be looking at this, and not a complicated chart. I'd be looking at just making sure that you've got your $1.25 million, and by my math here, you would have almost $2 million if you're saving a little over 15, and that's early. That's at age 62. So now you've got $2 million,
and he may end up saving more than that a year, especially as income goes up.
Then you've got $2 million saved, which if you just use the 4% rule, that's $80K in spending, plus all of your pensions and social. Now you're at $130. That's the way I would be looking at this planning. Fast forward, say, well, what would it take to get 100 a year, 100 and a quarter a year, and just use the 25X rule. That's the amount you would need in savings you do the math where you say, I want at least 50 from my investments, or in this case, I want 80 from my investments. The 25X rule allows you to do that, plus social, plus pensions. That's how I'd be looking at this.
Okay. All right, we're going to take a quick break, and when we come back, the $5 million American Dream.
Sounds expensive. Welcome back to Ask an Advisor. I'm Wes Moss, along with Krista DiBiase, here on the Clark Howard Show. Ask an Advisor session. We talked about, let's see, what did we talk about in the first segment? Inflation and stocks. This is a broader topic about the American dream and the cost of the American dream. And this is not a number for retirement. This is the amount that supposedly, according to Investopedia, and this is an article that's been floating around recently, and I've had a couple different people ask about it, so I wanted to cover it here, on how much you need to earn over the course of your career to pay for all the big stuff. The big chunk of it is retirement savings. So they're estimating you need, again, these are not my numbers. This was the Investopedia saying this is what you need. And I would agree with some of these numbers and I would disagree with some of them, but let's just, according to their lights, retirement is the biggest chunk and you need $1.6 million for that. Again, the $5 million is how much you should be earning in order to have the spending power to do all these things. Healthcare, they estimate $414,000.
This is per person?
This is for it's really should be for a household.
Okay.
But if you're single, it's per person.
Okay.
For the most part. I look at this, Krista, as a household.
Okay.
It's hard enough. Remember, what the statistic is that half of Americans have no retirement savings at all. The median retirement account right now sits at $134,000. Not even close to the 1.6.
Right.
Investopedia is saying. So they say you need 1.6 million in retirement savings. Healthcare is going to cost 414. Home ownership is 958K. Let's call that $1 million. Again, median single family home prices right now at about 415,000. And then they base that off the 30-year fixed mortgage rate, which at the time they did this, it was about 6.5. They're saying the cost of kids, to raise your kids, and then the cost to send the kids to college, they're putting that at $650K to raise the kids and $230 for college. So that's $875,000. So almost $900,000. Cars. Now, I don't know, maybe Clark will have a heart attack on this one. $900,000.
Wow.
Over the course of your lifetime. They're estimating 2 new cars every 10 years.
Oh, wow. Yeah. I mean, that probably is average. Yeah.
The vacation budget, again, this is for your lifetime, $180,000. Pets, $39,000. They're taking the average cost for 1 dog and 1 cat.
Oh my gosh.
And veterinary bills and food, etc. And then, a wedding. I guess they're assuming that only one of the kids get married.
Okay.
Or maybe you pay for one of the two, and they're saying $34,000. $38,000 for the wedding. You add it all up, that's $5 million. Which, by the way, is the first problem I have with this article. That's after taxes. So it means you have to earn about $7 million in gross pay in order to net down to
over your lifetime. Yeah. Wow.
I don't know if I would just say that I understand the car number. I understand home ownership, that number. Most people aren't just paying for the first house in cash. You're going to pay some interest to have a mortgage. Healthcare, hard to argue with that one. And then 1.6 million in retirement savings. That to me that gets you into what I would consider the green zone of retirement savings. I've done a lot of research around this, and I think that is an appropriate number. The retirement green zone, in my opinion, starts at $1 million in investable liquid assets for retirement. So I'm not going to argue with the 1.6 million. Now, how do you have to what would you have to make in order to make this work? And I'm looking at, now I think a 30% tax rate may be a little high for some people, but if you're 25% federal and 5% state, so again, depends on where you live here, but that's the number I used. To net $5 million, you would need to make $7.14 million, which essentially is $160,000 a year in gross income. They're looking at this over your 45-year working life.
Wow.
Now, there are
Seems realistic.
It does seem realistic.
No,
45 years?
But making that much for 45 years.
You're right. That part is
that's
really
insane
hard
to me.
But here's I would think the good news, because let's get a dose of reality into this. And there's a big difference between saving your way to the American dream and then investing your way to the American dream. And if you do the numbers, because the biggest chunk of this is retirement savings. If you were if you're just saving your way, and you're going to put away $1.6 million, assuming no rate of return, which that's probably artificially low as well, then you need to, by my math, you need to make you have to average $160K a year. But if you were to save every year and invest those dollars, in order to get to 1.6 million by the time you're done your 45 years, it's not nearly as much having to be socked away as you might think. By my math, you would have to earn about $480,000, which would net to about $338,000 over that period of time. And if that compounded at 6% over time, then where do you end up? Well, you still end up with the 1.6 million, because the net 308, call it 340 grand, which would be $7,500 a year or $650 a month, growing at 6% a year, then you get to that number. You get to the $1.6 million in savings. And to me, that's the biggest cost of this whole equation. Now, if you do the math on that, you end up with having to earn about let's call it $120,000 a year. So saving your way to the American dream this is trying to put it into perspective for all of us. Like, what does it really mean over 45 years? You'd need to earn about $160K gross. If you invest your way to the American dream, that number drops all the way down to $120,000. So 6% for 45 years, $7,500 a month, or $7,500 a year, or $650 a month gets you to the 1.6 million.
Yep.
So I don't really, it's expensive.
It is.
It's a lot of earnings over a 45-year career. $7 million, depending on your tax rate, it could be $6 million if you're a lower tax rate, to net down to the 5 that they're saying in this study. And I don't think it's that far off, and it's a big mountain to climb.
Yeah, it is. And I think, of course, all of this, like you've always said, is affected by what is your lifestyle going to be in retirement. You know, are you going to pay for a $35,000 wedding? Maybe a lot of people wouldn't. I mean, there's so many. Do you need a new car every 10 years? So, you know, there's so much that we can do. And that's what, Clark talks about so much, is like figuring out how to live with. What would
you guys say about a $40,000 wedding? Crazy or normal?
He would think that's insane.
Insane. Think about this though. The $1.6 million. And if you use the 4% plus rule, I'm just going to use 4.5% for easy math. That's $72,000 a year in income starting in retirement. You add another $40K in Social Security, or maybe a pension as well. You're at 112.
Yeah.
if you don't have a mortgage,
That's
a
key.
lot of people in America can live on that.
Yeah, and maybe when they're younger, a lot of people are paying down their mortgage, so their expenditures are much higher than they might think they're going to be in retirement if they get that paid off. One of your keys to a happy retirement, as you say, not having a mortgage, right?
That is wonderful. Oh, really? In the newest book that is still yet to be released, it is having your mortgage pay off within sight.
Okay.
So if you have you have 30 years left, that's bad for retirement happiness. If you are within a certain amount of years, so there's light at the end of the tunnel, that adds to retirement happiness.
Okay. I cannot wait. We'll hear more about that book, I'm sure.
Yes.
Any idea of when it's going to be released? Approximately?
Hopefully sooner
Okay.
than later.
All right. We'll go to questions. This one came from Joe in Georgia. Should I continue to carry a large life insurance policy on my wife and I? I'm 58. She's 55. I'm paying $1,900 a year for $200,000 for me, and I have 2 grown children, one of which is still single, and we supplement his income. I have $300,000 in a 401k, and I own 7 rental properties that are worth around $1.7 million. We have $125,000 in debt, most of which is our primary home. I would like to invest the insurance premium in my 401k to catch up on the catch-up
On the
fund.
catch-up. Yep. Joe, I would say this is just, you could ask 10 people on this and maybe get 10 different answers. In large part, insurance has done its job, meaning that we want insurance, we want to pay for insurance, but we obviously don't want to have to use it. And that's why we do lower cost term policies. And then hopefully you've just wasted all your premiums and everyone is now financially independent. You're financially independent for retirement. The kids are out of the house and you don't need the insurance anymore, so you can stop paying it. You are not, in my opinion, you're not quite there. So it makes sense to say, well, I don't really need this anymore. I can go ahead and drop it. But if you were to just start today, is it a good deal to have $200,000 that would come to your wife if you passed today for $1,900 a year? In my opinion, that's still a low amount of money to protect that much that would add that much in assets. Because remember, if something happens to you, your wife will go down to just one Social Security payment, not 2. You won't have both of you together for retirement. So I think that, I know you're 58, so you're getting close to the point where I think you could think about giving this up. But you're in my opinion, you're a little far away from that. And I would continue to do the $1,900 for the $200,000. Remember, it's insurance. It's in case of something really bad happens that you don't expect. Sure, you could invest the $1,900 over the next, call it 5 years. Is that really going to get you anywhere close to, if something were to happen in 3 or 5 years and you pass, it doesn't come close to the $200,000. So my opinion, even though you've got $2 million between your 300 and your 1.7 in real estate, and you're pretty much funded when it comes to retirement, I would not be getting rid of that insurance policy today. That's just my opinion on it.
I assume it's term life.
I'm assuming it's term life.
And what I would do though, because I just recently re-upped, I did an additional 10-year term life policy. I would shop it around a little just to see if you look at 10-year policies and how much they would cost, because that does sound a little high to me, unless there's some medical underwriting issue for term life for that much money.
But it is the bird in hand.
Right. But you don't have to do anything. You can keep that policy, or you can shop it around. I would
shop around and see what a brand new policy would cost. Again, based on where you are health-wise. We don't know.
Yeah.
So that's another option. If you could get the same amount for less over the next 5 or 10 years, maybe it's worth doing that too. But I would be of the mind of not getting rid of the insurance just yet.
Steve in Missouri says, "Hi guys, I have a question about saving in 529 plans for my children. My wife and I go back and forth on how much to fund their college and how much we're willing to help them on that. But I found an interesting loophole. I opened 529 plans for each of my kids the year they were born. Under the Secure 2.0 Act, I understand I can roll over up to $35,000 from each 529 to my child's Roth IRA, penalty and tax-free, as long as the account is at least 15 years old and my child has earned income. My plan is to fund each 529 so that by the time they're 16 and working, I can roll over the Roth IRA maximum each year and get the full $35,000 transferred by around age 21 or 22, letting it compound for decades. Is this approach sound under current IRS rules? And is there anything I need to watch out for, such as contribution limit interactions, plan-specific restrictions, or better account options to maximize long-term growth? Instead of using this 529 money for college expenses, I'd love to kickstart their retirement portfolios with rocket fuel instead, letting the magic of compound interest do its thing for several decades. Is this a good strategy? Thanks.
Steve, I think it's a great strategy. It really is. I love it. This is a very real rule. This isn't just some loophole. This is IRS approved under Secure 2.0. They say you're able to roll over 529 money, but there's a limit to it. You can only do $35,000 from a 529 to a Roth, and you can only do up to the contribution limit in any given year. So it's going to take a while, and I think the other caveat is the 529 account has to be pretty old. So I believe it needs to be a 15-year period.
He said that, so I think he does know that.
And then the beneficiaries, it has to have some earned income, et cetera, which obviously can happen as kids start working. So I would say it's a really good plan. You've got to be careful about rolling over contributions or earnings on those contributions in the last couple of years. So you've got to be careful about that. But I think it's a really good idea. If you think even $35K growing at 7% a year could be $500,000 by the time your kid retires. So your children retire. So I think it's a really good number. The question is then, how do we pay for college? And I think about this and again, there's no right answer on this one, but I always think of this as a third, meaning that depending on where the kids go to college, I mean, you could be in a state like the state of Georgia where you go to in-state school, maintain a certain grade point average, and it's extraordinarily low, almost free for tuition. Not every state is like that. Where is Steve coming from? Did he say?
Yeah, Steve is in Missouri.
I don't know how it works in Missouri, but I think of it as kind of the third rule where you want to, and this is why most people don't retire until their kids are already out of college, is that one, you help them pay for a third of it while you're still working and they're in college. Two, a third of it comes from savings. 529 plan that you already have. Maybe it's another type of savings. And then three would be to have the student either pay for a third of it or take out loans. And I think that allows skin in the game. So you've got everyone's kind of sharing what has now become an enormous number for most families. And depending on your state, you've got to be able to break up a cost like this. A third coming from while you're working, a third coming from savings, a third coming from the burden on your children having that college debt so that they're skin in the game. So the question is, what are you going to do on the savings side? And are you planning on continuing to work until they're through college? There's only so much we can squeeze out of the orange here. I think if you had to choose and figure out how you would pay for college, I think advantage goes to the potential of several $100,000 long-term in retirement for the kids. So I think it's a really good idea, but still going to pay for college.
Yeah. Okay. McKay in Georgia says, I love this show. Crazily enough, my kids ask to listen sometimes. Anyway,
That's because of you, Krista. They like to hear you.
No way. Absolutely not. Anyways, I've had this idea for some time. I want to invest our disposable income in some way to balance enjoying it now, but also have it grow so that it bumps up our baseline lifestyle before retirement. I have a very steady paycheck and I love my job, but I don't expect significant raises. How can we do this? I'm happy to consider more complex solutions if they squeeze out more over time.
This McKay, first of all, I can't believe your kids listen. That's pretty cool.
I know. Clark would make a joke about they're probably falling asleep in the car.
They are. I can just tell you, my kid. I've done radio and podcasts now for almost 20 years. I guess 17, 18 years. And when my kids were really young, I think they thought it was somewhat cool. Mm-hmm. And then after the first year or two, they just absolutely could care less.
Right.
And they turn that off if it comes on. Mm-hmm. And the only time I ever hear about being on the radio for my kids is when one of their buddies at school say, "Oh, I heard your dad on the radio." Mm-hmm. And they're like, "Yeah, whatever. I don't even know what he's talking about." So anyway, it's cool that they're learning. They're going to be very smart kids. The number one. Number two, this is kind of I think your question, McKay, goes back to the automatic increases in savings that you're able to stomach and not make it so that you can't pay the rest of your bills. Mm-hmm. And the more and more 401k plans, and in fact, I believe now after the Secure 2.0 Act, any new 401k plan allows for this. So not every older 401k plan does, but most of them do. Is that there's an escalation option inside your 401k contribution, and you can have it automatically ratchet up your savings. I think it's just in 1% increments. And I don't know exactly if you can do it 4 times a year, once a year. But even if you do it once a year, McKay, and you may not notice that extra savings that you're getting. So you maybe you're saving 8% today and you go auto escalate, and in a couple years you're at 12, 13, 14%, and you may not have even noticed that you're saving that much more in your retirement accounts. So you're almost tricking yourself into saving a little bit more. You said that your salary is going to be pretty much level. So there's only, again, so much juice you can squeeze out of your salary and put into savings. And it's really hard to manually do that. So I would look at this as just you're tricking yourself into saving more by turning on the auto ratchet up higher contribution limit inside the 401k. The other thing you can do is just to get started, and it doesn't have to be a huge amount of money. Maybe it's the amount you won't miss much. Maybe it's $100. Maybe it's $200 a month. And you're doing that in a brokerage account. And you're doing an auto investment plan, and you're doing a reinvestment plan. And you may not miss that all that much either. So I think that there's 2 ways to kind of trick yourself into saving more. First of all, it's starting small. But you're doing it today. And if you do that for another 10, 15, 20 years, sounds like if you got young kids, that could add up to more than you might think. So I would think about tricking yourself into just saving a little bit more this year that could turn into a lot more in the future years and then add up to an awful lot way down the line.
I love that McKay has a job that's so fulfilling too. I think that's so important. Even if they're not expecting significant raises, it's
steady paycheck and he loves his job.
Yeah.
Could he say that?
Could be a she, right? McKay. I'm not sure.
I don't know.
Yeah, loves the job.
I only know one McKay.
Okay.
As a guy.
Okay.
I don't think this is McKay that I know, but anyway.
Okay.
Do we have more questions or? Are we at the end of the line?
That's it, man.
Okay.
We're done for
this
the
episode.
day.
It's a wrap.
It is. Thank you for joining us. Please share.
I love these questions, by the way.
We've got plenty.
We have a great audience.
Yep.
It really is.
Oh, no question. Best audience in the entire country. I'm absolutely convinced. People are so nice. There are a couple on YouTube who aren't as nice, but that's okay.
That's okay.
Most people are fantastic. Thank you so much. Share this episode with a friend. Subscribe, please, to our YouTube channel or wherever you listen. The YouTube channel is youtube.com/Clark. And hope you have a great rest of your day. Clark is back tomorrow with a brand new episode.